Hi, I'm Kara Murphy, and this is Money with Murphy. Over the last several years, business investment or capital expenditures or CapEx has been dominated by a very small group of companies, the hyperscalers. Giants like Amazon, Microsoft, Google, Meta have poured hundreds of billions of dollars into infrastructure needed to fuel the AI boom. That spending has been a major force behind the buoyant returns delivered by big tech and the Magnificent Seven since ChatGPT's launch at the end of 22. But 2026 could mark an inflection point. Today, we'll cover why CapEx matters so much, why investment has been concentrated among a relatively few companies, and the catalyst that could spark broader participation across the rest of the economy. Business investment is a strong driver of long-term productivity and economic growth, key drivers of long-term stock market performance. CapEx dollars, though, also come with risk, namely that companies will not see the returns that they hope for. Nowhere has this been more evident than with the hyperscalers and their pursuit of winning the AI race. Investments in AI-related infrastructure, including chips, data centers, power, has grown exponentially. Estimates say that three largest cloud service providers, Amazon, Microsoft, Google, and Meta, will have spent over $350 billion on infrastructure once the final numbers for 2025 are in. However, so far at least, this level of investment hasn't diffused to other parts of the economy. Why? Because most companies haven't had the same incentives or ability to invest. Big tech is spending because the AI race is one that they can't afford to lose. But for the average business, higher borrowing costs, supply chain uncertainty, bottlenecks have relegated them to the sidelines. Companies across manufacturing, industrials, utilities haven't been able to commit to large-scale projects. Until now, the incentives just haven't lined up, but that may be changing. Why do we think this trend may be broadening out? Really, two reasons: lower interest rates and favorable tax treatment. The One Big Beautiful Bill Act carries multiple provisions designed to incentivize investment. With the legislation set to take effect this year, the OBBBA allows companies to fully deduct expenses on research and development and equipment. This provision dramatically lowers the after-tax cost of investing in productive assets, making long-term projects more attractive. Newer sectors stand to benefit from investment in physical infrastructure and technology, including industrials and materials. A broader CapEx cycle could reshape the stock market by boosting earnings and allow what has been a very concentrated market to broaden out. We'll be watching closely to see if those dollars that are being invested today enjoy the returns that investors are hoping for. And until next time, invest wisely and live richly.